Well, whatever the Fed decides, emerging markets around the world are bracing themselves. Many of these countries are suffering from the uncertainty, and that uncertainty is hitting their currencies. Sumitra Nydoo reports from South Africa.
Global markets are on tenterhooks as they await a U.S. rates decision. If the U.S. Fed hikes rates on Thursday, it will be the first time in 9 years. The move is expected to prompt a complete reversal of investment flows away from emerging markets to the United States.
We are heavily reliant on foreign capital flows in terms of actually spurring investment in this economy. And unfortunately, fortunately that worked whilst global capital flows were very generous and were flowing into emerging markets. But unfortunately, that tide seems to be reversing right now.
The rand started its weakening trend earlier this year when the U.S. Fed first hinted at a rate hike. Since China devalued its currency, the rand has taken further strain. The currency has lost over 20% this year.
The rand's been continuously weakening against the dollar. And in the past few months, the rate of depreciation has really accelerated. It's an emerging market sell-off. The rand is caught up in that. The rand is weakening against the dollar, against pretty much all the developed world currencies.
Not good news for an economy already trapped in a low-growth cycle. While the weak currency is an opportunity to reduce the country's current account deficit, many are concerned that South Africa does not have the capacity to improve its export growth. Slowing demand from China is adding to these concerns.
We remain a structural net importer, and unfortunately that leaves us predisposed again to vulnerability. When the rand weakens, it's generally more negative for South Africa than it is positive. If you factor into that, the implication for debt in South Africa, the implication for the ratings agencies, what is concerning is that we run twin deficits.
With the rand likely to stay at weaker levels for the rest of this year, the Reserve Bank may be forced to hike rates for a second time this year in order to control inflation.
No matter what the Fed does, the Reserve Bank will come through and hike interest rates next week. That's because inflation is rising. It's going to breach the 3 to 6% range that they target. So even with a weak growth environment, the Reserve Bank is going to have to act, we believe.
And there may be little else the bank can do to stem the currency slide.
South Africa has very low reserve levels. They can't intervene to stop the currency going down. South Africa is just a reflection of global forces. South Africa can't fight the strength of the dollar, a Fed that's hiking rates, weakness in China's economy.
If the U.S. Fed doesn't hike rates this week, it will provide some relief to emerging markets. For South Africa, though, it will be short-term relief, as the country is still grappling with its electricity crisis, low growth and high unemployment. Sumitra Nydoo, CCTV, Johannesburg.